The stock market is largely regarded as the most important indicator of a healthy economy. This has always seemed very unusual and strange, since the corporations and the globalists own the majority of the stock market, yet the real economy is made up of the middle class. We have a dying breed. The middle-class citizen is slowly being weeded out into the pages of history. So, what is a good indicator of the health of an economy? Well, you came here for the truth, so let me unveil that for you. Today we will discuss the Fed has now admitted that the stock market is not a good indicator of the economy. I couldn't believe it, but I read it with my own two eyes. I had to make a video just on this alone. It's so important. It's so crucial that we now have the Federal Reserve themselves admitting this, something that I've talked about countless times. And of course, you read the mainstream media, the propaganda media, and they, even after this, will not be in line with it, of course. But let's look at these words. Turbulence in stocks and bonds was part of the Federal Reserve's calculus for slowing the interest rate increases in February. Now, an economist with the central bank's Dallas branch says relying on the equity market for economic signals is a mistake. So here we are, the Dallas branch of the Federal Reserve saying, if you look at stocks for the economy, you are making a, quote, mistake. That's what they're saying right here in the Bloomberg article. Benchmark gauges such as the S&P 500 are such flawed mirrors of the economy that they probably fail as predictors of the GDP, according to a new paper. An economist in the research department at the Federal Bank of Dallas. Half the components are manufacturers for one thing, much more than is reflected in the GDP. And they're basically saying, look, the way it's made up of, it doesn't correspond. So if you're trying to basically compare the two, you're comparing the wrong two things. It's not going to work out, or you're not going to get an accurate measure. But there's other reasons to believe that it's not a good indicator. And when you have a direct correlation between the Federal Reserve's, obviously a good choice here, the Federal Reserve's balance sheet and the S&P 500 being directly correlated, you have an issue. Let's look at this here from my book. Oh, this first. The MSCI All World Index start to 2016 caught in the Fed's eye. And what they're looking at here is the central bank started citing global market headwinds and policy discussions. As you can see, the beginning of the year taking a little dip. But what's more important than what they're trying to highlight here? They never focus on this. And look at this. Here is showing you the Google Finance. Over the past couple years here, we're looking at approximately where the Federal Reserve ended QE3. That's what I'm trying to show you. From the point where QE3 ends to present day, as of this recording, we essentially have no movement, give or take. I mean, let's be realistic here. No movement in the stock market, trading within a range. So what does that tell you about the value, the lasting power of QE3? The Federal Reserve stimulus is the most important indicator for the stock market. That's what I see. But of course, not taken into account. From my book, this is what I wanted to talk about. We have to look at the people who are giving us information. We have to look at the people who we are supposedly want to entrust our money with. And you look at this. Investment media is bombarded by self-proclaimed, quote, gurus, analysts, and money managers. And hopefully I'll remember to touch on a point here. Unfortunately for them, their performance speaks for itself. In the most recent economic crisis, trillions of dollars were evaporated in the financial markets, all through the hands of the so-called experts, from whom most people take their advice. Think about that. You go to the bank, you leave your money with them, and they say, look, this is the performance over the last 3 years, 5 years, 10 years. This stock, this mutual fund, has done extremely well. Therefore, you have such and such risk tolerance, and you would be a great fit for this mutual fund. So they put your money in there, it gets pulled in with everybody else, and they do what they want with it. Hopefully you get a return out of it. And that's what's really happening here. These are the gurus. These are the experts which you leave your money with. And in fact, if they are not an expert, well, then why are you putting your money with them? These are the experts. I mean, you watch Jim Cramer on TV, take his advice because he's an expert, right? I mean, or else, why would you watch him if he's not an expert? See, this is what I always say. You know, when you watch the Money GPS, you're not looking at somebody who's trying to tell you what to do. I'm not saying, you know what, get out there, invest in Walmart. I saw a dip in their stock, and now's a great time to buy. Some of the other channels in the alternative news, perhaps you watch them as well. You get out there and they're trying to suggest stocks to purchase. Now, that's fine if they want to do that. Absolutely. That's what YouTube is all about. Sharing information. But when you come to this channel, you're getting empowered. You're getting the information which you need to then go look into things yourself. You're not going to get which stocks to invest in at this time. I don't do that business. That's a risky business. I don't even get into paper at all. I think you should get your money out of paper. That's the way I look at it. So a lot of times that, you get some so-called haters out there, but they don't know the Money GPS, that's for sure. Anyway, let me just end the video right there. If you found it informative, please give me a thumbs up. And last but not least, if you found this video informative, I know you will find my book, The Money GPS, even more informative. You can actually look through the book. Head over to Amazon. They have a look inside feature, which will allow you to flip through the pages of the book and see if you like it. Take care.